All right, our next speaker is going to be Ethan Lenz. Ethan?
Hi, I'm Ethan Lenz. I'm a partner in Foley's Milwaukee office, and I'm a member of our firm's insurance industry team as well as the insurance and reinsurance litigation practice. I've got a practice that's primarily focused on providing risk management and insurance coverage-related advice for a number of our commercial clients, particularly in the areas of D&O insurance and representation and warranty insurance. I also do a wide variety of work on a number of other commercial and professional insurance program issues.
All right, thank you. And our final speaker today is going to be Ryan Collier. Ryan?
Hello, everybody. Thank you, Ellie. Good afternoon or morning to each, depending on your location. My name is Ryan Collier, and I'm the President and National Practice Leader for the Executive Lines Division within Risk Placement Services, which is a subsidiary, wholly owned subsidiary of Arthur J. Gallagher. My exclusive focus is publicly traded and privately held directors and officers insurance and the placement of those coverages from an insurance brokerage perspective.
All right. The agenda for today's program is going to be as follows. We are going to start with an overview of the financial crisis, and Aaron's going to cover that section for us. Then Mike's going to take over and discuss the potential exposure and implications for directors and officers. Once he goes through that part of our presentation, Ethan Lenz will then describe the types of coverage and claims, and then we'll follow up with Ryan, who will discuss the myths of D&O liability. Once we finish with the content portion of the program, we'll go into a little bit of a panel discussion where our panelists will go over some important information. Following the panel discussion will be when we will address our questions and answers. So with no further ado, let's go ahead and get the show on the road. And Aaron, you may begin.
Thank you, Ellie, and I'm going to rely on you to move forward. So I'll begin with the first slide titled Economic Observations and Equity Market Performance. The conversation today we're going to focus on is going to be geared towards a discussion on bank stock performance, and general financial performance from a bank's point of view. And we'll use this as a platform to have a broader discussion about the health of the general U.S. economy. And knowing that there are officers, directors, and employees of companies that are not banks on the line here, we'll again try to keep this as general as we can. Today we're going to, if you look at the upper left-hand side of this part of this slide, we're going to review the trailing 12-month market performance of a few broader indices from an equity point of view. And what you'll note is, generally speaking, performance has been quite strong over the past 12 months. Certainly since August of last year, you've seen very strong performance out of the equity indices. The Russell 2000 being up about 20%, and the Dow and the S&P both up about 10 or 11, 12%. So generally speaking, very strong equity market performance, certainly dissimilar to what we've experienced over the previous 2 or 3 years. From a macroeconomic point of view, there's a few key market drivers to call the group's attention to today. The economy does still continue to advance, although the growth has been at a very slow pace or sluggish, and from a recovery point of view, it's been rather sluggish. Consumer spending, which is about 70% of the GDP, rose about 1.5% in the first quarter, down from 4% in the fourth quarter of 2010. So certainly there are some headwinds in the economy that we're facing currently, and that is not causing a recessionary concern, but really more causing a very sluggish recovery concern. Unemployment, positive unemployment did continue to fall in March to 8.8%. That's down from about 10% around November or so. So reasonable period of time we've seen unemployment coming in. That is a positive. Of course, mitigating that positive, you see long-term concerns still remaining related to federal debt, local debt, municipality debt, in general financial health of the government. Certainly we're seeing that as a hot spot as we barely come to agreement on the federal budget for this year, and we're already well into the second quarter. Finally, from a macroeconomic point of view, there are still general concerns regardless of recent rhetoric related to higher rates and inflation. Certainly the bond market has been signaling higher rates pretty consistently, and that does still remain and will continue to creep into the macroeconomic conversation. The lower left-hand side of this slide, you'll see what we tracked here in the equity fund flows. This is just raw dollars flowing in and out of equity funds over the past 12 months. And you'll note a couple of trends. After a substantial period of negative outflows, really beginning in about November of 2010, you started to see some meaningful inflows, $5 billion in December, about $20 billion in January. And you're starting now to see, while there are positive dollars in February, some negative dollars in March. The trend is on the decline, certainly causing some volatility in the indices you see right above that chart. But that being said, major indices have experienced strong performance. From a bank's point of view, the first quarter earnings are generally expected to be positive. You see some confirmation on that over the past couple of days. JP Morgan coming out with rather robust earnings, and we'll talk about that in some upcoming slides. Ellie, if you flip to the next slide. From a market performance perspective, we thought it would be instructive to chart the last 3-year market performance of the S&P 500, so a broad index, against both the NASDAQ Bank Index and the BKX, which is a proxy for the larger banks. The NASDAQ Bank Index really being a proxy for the regional and community banks that are publicly traded. And interesting, you'll see over the past 3 years here, the S&P is basically flat. It's down slightly, not quite 1%. The NASDAQ Bank Index down about 26%, and the larger banks down about 34%. Now, you'll recall over this time, massive volatility. That's not really demonstrated here, but you do see that March 6th of 2009 marked a low on really all of these indices. It's a very easy date to remember, and I'm sure it's one that the group has heard previously, 369, March 6th of 2009. Ellie, if you'll flip forward to the next slide, please. Charting since those lows, that March 6th of 2009 low, you'll see a very different story related to these same 3 indices. The large banks are up just shy of 200%, up 181%. Now, that's not surprising when you see the likes of Bank of America trading at maybe $12 or $15 a share. You recall that they made it as low as about $2 a share down in that March 6th time frame. So really, the story here is the big banks were beaten down. They've certainly recovered nicely since March 6th of 2009. This is relative to performance on the S&P 500, up about 100% or 94%. And then you see the NASDAQ Bank Index. Now, again, this is a proxy for a smaller bank, a community bank or regional bank. They have not experienced, while they've had nice performance, they've not experienced the same robust kind of market recovery that their larger brethren have. Those banks up about 50% since March 6th of 2009. So we might ask why that is. And Ellie, if you'd flip to the next slide, please. From a performance point of view, and this is really tracking profitability and non-performance and charge-offs, or provisions and charge-offs, excuse me. From a profitability point of view, you'll see on the upper right-hand side of this slide, profitability has returned to the industry in 2010. That's expected to continue in 2011. And you'll note here that the profitability the industry has experienced in 2010, while meaningfully higher than that in 8 and 9, still remains about half that of what had been the historical or the more normalized experience back really in 2007 and previous to that date. One of the drivers that's important to note here in 2010 and a trend that has emerged, you can see in the red circle on the lower right-hand side of this slide, a driver toward this profitability or this net income. And again, this net income is all FDIC insured institutions, so it's not regionally specific nor is it size specific. It's all FDIC insured institutions rolled up into a chart here. If you look at that red circle, you'll see what we call a reduction in the reserve build. You'll see the blue line representing the loan and lease charge-offs and the gray bar representing provision. And for 2010, you can see the provision does not total in all quarters. It does not get as high as the charge-offs have. So said differently, loan loss provisioning has not been as robust as it had been in the previous quarters, and you can see it really spiked at $71 million in the fourth quarter of 2008. So one way to look at that is credit trends are improving, and I think that's a very positive sign as we look ahead that credit trends are improving for these banks, and banks will be likely more inclined to probably not relax lending standards, but actually deploy some capital in the form of loans and lending to business particularly. Another negative is a lot of that performance you see on the upper right-hand side of this page, a lot of that performance is related to a reduction in reserve build. So the performance, said differently, may not be as robust as those numbers actually indicate. Ellie, if you'd flip to the next slide, please. To support some of what we're seeing out of those numbers, you'll see here non-performing asset trends, and I won't go too deep into this slide, but a key takeaway here is non-performers on bank balance sheets remain at a very high level. Certainly relative to a more normalized time back in 2007. You can see the fourth quarter of 2007 here at a pretty meaningful level of non-performers, totaling about $124 billion in the industry. That came in compared about a quarter of where we came in the fourth quarter of 2010. So while you're experiencing some credit stabilization, while you're experiencing in these loan portfolios an understanding of where their problems lie, these problems are leveling off at a very high historical rate. We move to the next slide, please. Related to a return on assets, you can really look at banks and return on assets or return on equity. And return on assets, you can see that while positive for 2010, return on assets is tracking here well below approximately half of what a more normalized return of a 1% rate, or you can even see 1.25% back in 2007. So profitability again is starting to return, but it is slow, it's sluggish, and it's certainly not back to the levels of a more normal economy. So we're getting there. We're getting there, but we're getting there slowly. Certainly the fears of a recession have abated a bit, but this long, protracted recovery may in fact prove to be more challenging than a recessionary environment. Flip to the next slide, please. Related to capital requirement in the industry, and part of the reason why banks have been challenged to both grow their loan portfolio and actually deploy their capital in the form of loans for assets. You can see here a heightened level of tangible equity to assets. Really, the equity banks are required to keep on hand to support their balance sheet. We made it to a very low point, certainly from a historical perspective in 2008 at 6.3% in the third quarter. You can see a meaningful increase in that ratio really over 2009 and well into 2010. We're starting to feel a little bit of stabilization here at about the 8.5%, 9% on a national perspective, and we'll talk a little bit more about that in a moment. Next slide, please. A large reason for that massive increase in the tangible equity to asset ratio has been equity offerings and new capital coming into the industry. Certainly investors have deployed quite a bit of funds, and we'll talk about that in a moment, in the industry. Part of the rationale for that has been, to name a few, TARP redemption, and you'll see TARP redemption continue, although that may continue in the form of refinancing through the Small Business Lending Fund. About 600 small banks have applied for that already, totaling about $10 billion in requested capital that is likely to be funded later on this year. Certainly new capital standards related to Basel, related to Dodd-Frank, related to other recently enacted legislation. You hear a lot about an 8, 10, and 12% capital requirement as the new norm. To just look back a few years, that 8 was 5, that 10 was 6, and that 12 was 10. So meaningful uptick from a regulatory point of view as to what the capital requirements are likely to be, although there is still some uncertainty as to whether we're going to see those be official or if those are going to be unofficial requirements. But that said, you're going to see a meaningful amount of equity being required to support the balance sheets of these banks as compared to where we came from in the 2005-2007 timeframe. You'll likely see some individual minimum capital requirements, particular to targeted institutions or specific institutions. You'll see those institutions in all likelihood having meaningful concentrations in the likes of commercial real estate or C&I lending. And as capital requirements for banks that are specifically targeting commercial borrowers increase, you're likely going to see them less likely to meaningfully increase the size of their lending portfolio. So the impact on the overall economy will be that these higher capital ratios, while creating less risky institutions, are still going to prolong this economic recovery, probably not several quarters, but several years. And then finally, recently enacted federal legislation with Dodd-Frank, a meaningful portion of bank balance sheets relied upon trust preferred for funding on the equity side. For the larger institutions, that trust preferred is going to be phased out as Tier 1 capital. For the smaller institutions, they will not have an impact, although from a market point of view, if you're a publicly traded company and you happen to be under that $15 billion grandfathered threshold, there is a view that institutional investors will basically treat you like they would the big guys. There's going to be a move away from trust preferred even for the smaller companies as well. Ellie, if you could flip to the next slide, please. What has occurred, I won't dwell too much on this. I think it's been in the journal plenty. You can see that about $93 billion in new equity was raised in 2009. About $55 billion in new equity was raised in 2010. This is specifically for the bank and thrift industry. A whole lot of capital coming in. A lot of that capital was to fill a hole. A lot of that capital was to refinance TARP, and a lot of that capital was to bolster regulatory capital ratios. As far as who's done it, you'll see on this slide in 2009 it was dominated by the multinationals, super regionals. 2010 that trend continued, but you saw larger community banks moving from about a 6% to an 11% portion of that pie. So you're seeing some small companies now starting to access the capital markets. Capital markets still remain relatively closed to the smaller, the sub-billion-dollar issuers and market cap, having a difficult time raising at a reasonable valuation. And banks still enjoy, you can see some averages, but the averages tend to be market cap driven. If you remove the market cap weighting, banks still enjoy about a book value multiple, so certainly not an attractive valuation to raise capital from. So some headwinds that do still exist related to an equity offering point of view. Next slide, please. From an M&A point of view, consolidation in the industry, there are about 7,600 banks nationally now. There were about 8,000 banks last year, so you've seen about 400 of them go away for a variety of reasons. Consolidation has not been robust and will likely not be robust in 2011, although you'll likely see more normal deals done in 2011 than you saw in 2010. But we're not going to return to that 300, 400, 500 deal year for quite some time. That's likely going to be driven and based upon the economic recovery. As banks in the general economic recovery improve, buyer valuation will likely improve, and buyer valuation is going to drive these deals. We're not likely to return to a scenario where banks are getting paid 3 and 4 times tangible book value in a transaction for some time. A new normal feels much more like 2.5 times book value, and will slowly climb from there. From an FDIC point of view, and really from a valuation point of view, you're seeing banks right now being sold at book value. If you go to the next slide, please. From an FDIC or a problem bank point of view, you can see here on this slide, it's a slide that's familiar with those who have tracked this. There has been a meaningful increase in the number of problem institutions, and there's been a meaningful increase in the assets of those problem institutions, although they tend to be very small institutions. There's about 800 or 900 banks on the FDIC problem list currently, and this is as of December of 2010. It's about $400 billion in assets represented. That's a lot of banks and a fair amount of capital, but the average size is very small. These are $400 and $500 million institutions. These are not the $5 billion institutions in your community, and they're certainly not the $40 and $50 billion institutions. So really the FDIC, the headline risk, the bank failures that we've seen over the past few years, that's likely to decrease, and as that decreases, as bank failures decrease, you're likely to see an uptick in M&A activity. The two will go hand in hand. Next slide, please. From the point of view of really economic recovery, and from the point of view of the banks, you can see on this slide the red represents areas where there are greater than 3 banks with greater than $1 billion in total assets that we would put on a problem bank or a troubled bank watch list. It's not to imply that all of these banks will fail, but it is to imply that their problems represent a meaningful portion of their equity capital, and their ability to continue to retain and earn money at a pace that can support what they currently have or growth is of question. It's not a surprise that you see California, the West Coast, you see Florida and the Southeast, and you see some of the states in the Midwest in focus here. These are troubled spots. These are economies that are less robust than others. You can see that there are a few problems in the Northeast and the Mid-Atlantic. That has generally been a resilient economy. So from a health point of view, if you kind of look at where the problem banks reside, you're going to see some of where the problem economies reside, and it'll help act as a guide for potential economic recovery and potential opportunity and potential challenges as directors think about where they want to bring and take their companies. And finally, next slide, please. Finally, I'll leave the group with a few observations and considerations. The near to medium term economic outlook still remains uncertain. There are certainly headwinds that we've discussed that face the economy. These headwinds are not likely to mitigate soon. There are some bright spots, but certainly we need to face some challenges, not the least of which is fiscal responsibility coming into these state and local municipalities and really sorting through some of their challenges currently. The yield curve certainly starting to signal inflation. Will that translate to higher rates? The Fed has given us some assurance and indication that that's not likely to come soon, but it's certainly a pressure, and it's certainly something the markets have been focused on. And credit quality at these banks. Credit quality remains a concern. You'll recall we have a slide here that shows that problem assets are still at historically very high levels. We have a challenging regulatory outlook. As these banks continue to get pressure, they are going to pass that pressure from a financial perspective down to the consumer. As that pressure comes down through the consumer represents about 70% of our GDP. That will likely continue to pressure the overall economy. And then I guess on a bright spot, M&A activity will likely begin to pick up slowly, and it'll probably track the economic recovery. But there are some very meaningful reasons why sellers are now really starting to consider coming to the table. Their expectations can come down a bit. And I'll call the group's attention to the fourth bullet point here, and board and management fatigue. There's a lot of tired boards in the bank and thrift space right now. It's been a struggle. They've faced a lot of headwinds. They're starting to come through some of them, and as they can unlock some value, it might not be the value they could have unlocked 2, 3, 4 years ago, but it is some value, and as they face succession issues, as they face increased expenses, as they face continued regulatory scrutiny, you'll likely see some of these tired boards come under the table and driving some of the M&A activity. And with that, Ellie, I'll turn it back to you.
Thank you, Aaron. We are now going to turn it over to Mike Matthews, and he's going to go over the potential exposure and implications for directors and officers. Mike, you have the floor.
Thanks, Ellie. Now that we've had a chance to discuss the current landscape, we're going to turn to discussing just for a few minutes essentially what are the armies that are massing and advancing across that landscape toward companies and their directors and officers from a litigation perspective. And in particular, what are the litigation and liability risks to officers and directors, and what and who should you be on the lookout for over the next few years? Oftentimes there is a lag time between economic disruption and ensuing litigation, and as to some categories of litigation, we're starting that phase, as to others we're well into it. Aaron referenced board and management fatigue. Nothing is more fatiguing than litigation. So we're just going to go over at a very high level to orient you to what's out there and what are some of the recent developments before we head into the directors and officers insurance issues. We'll talk about some of the developments in the law, both in the courts and in the legislatures, as well as federal agencies that affect companies and affect their directors and officers' ability to defend against and deal with those litigation risks. So first, we're going to talk about the FDIC and what the FDIC is preparing to do over the next couple of years. This is really an entirely new category of litigation risk that until recently was almost entirely dormant for the previous almost 20 years, coinciding with the S&L crisis of the 80s and the early 90s. Then we'll talk about the SEC, some of the new tools and the new positions that they're pursuing or planning to pursue over the next few years. And we'll touch briefly on the Department of Justice as well in that discussion. We'll talk about how some of the changes in the current landscape are affecting what plaintiffs' lawyers are doing in shareholder actions in particular. And then finally, we'll wrap up with some recent changes in the law that affect the ability of directors and officers to defend themselves against litigation. which will then segue into the D&O insurance issues. So first, the FDIC. We'll discuss what the coming wave is of FDIC litigation. Its first lawsuit against bank officers, which was filed less than a year ago, and there have been a few more that have started to come in. We'll talk about very briefly what the FDIC is considering when deciding whether to bring litigation, and then we'll briefly touch on the D&O insurance implications. Although the wave of FDIC litigation has not yet hit the shore, all indications are pointing to a similar scope of litigation as we saw during the S&L crisis in the 80s and early 90s. In the FDIC's Washington office alone, the FDIC recently hired 12 lawyers specifically to litigate these claims and to supervise private firms litigating these claims. And the FDIC former head of litigation has said that about half of the bank failures will see some kind of litigation, usually against directors and officers, although a few of the recent cases have also been against law firms for some of the institutions, as we saw during the S&L crisis. During the S&L crisis, the FDIC litigated cases against directors and officers in about a quarter of all of the bank and thrift failures, and about an equal number of cases against fidelity bond insurers, auditors, and law firms. And what we're seeing now in the last 12 to 18 months is that the FDIC is starting to reach out to former officers and directors of failed institutions, usually with some form of a demand letter or a tolling agreement or both. A tolling agreement is an agreement whereby a potential target of a suit agrees that the statute of limitations can be extended while the FDIC decides what to do. Many people sign those with the hope that the FDIC ultimately won't file, whereas if you don't sign them, very often you're inviting a lawsuit before the statute of limitations expires. Some of the matters that we're starting to see come in involve some of the very first institutions to fail in 2007 and early 2008, which suggests that the FDIC is in some ways going down the list and making sure that they get the first suits filed within the statute of limitations against some of the first institutions to fail. While the annual number of failures is lower than during the S&L crisis, the losses of dollars are substantial, and the FDIC has already authorized a large number of suits. There have only been 6 suits filed thus far, but the FDIC board has now authorized suits against 187 directors and officers for total damage claims of about $4 billion. Most recently, just a few weeks ago, the most recent case was against former senior officers of Washington Mutual, as well as their spouses, seeking an asset freeze and other relief. The first lawsuit that I referenced before was against IndyMac. That was in July 2010. We'll talk just for a moment about that case, which I think sheds some light on what the FDIC is doing. FDIC cases against former officers and directors are very different than securities class actions that we'll touch on in a few minutes, which have very stringent pleading requirements for fraud. The FDIC's typical claims are for negligence, breaches of duty of care, and similar causes of action that aren't as subject to motions to dismiss before discovery. So that means that very often that these defendants are going to have to answer the complaint, and they're going to have to head straight into discovery, which means depositions, document discovery, and so forth. Some of the factors that the FDIC is considering, they're similar to what they were during the S&L crisis. The material loss reviews during each of those 2 periods described inadequate policies and controls, overly aggressive business strategies, a lack of sufficient oversight, particularly over underwriting policies. Generally speaking, the FDIC is more likely to pursue those cases in which they can emphasize factors other than the economy and other market-wide effects. Some of the factors that the FDIC has mentioned is an uninformed or an inattentive board. The main factors there are a lack of knowledge or inattention to lending policies, failing to adequately reserve, failing to watch out for the risk management controls over lending. Also mentioned are operational weaknesses such as understaffing, and another one is overly aggressive activity such as rapid growth that's too aggressive or that is over-concentrated. For example, in the Bank United case here in Florida, it was option arm products. Although the FDIC has the most interest in maximizing its recovery, and so you would think it would focus resources on the larger cases, which is true certainly as to IndyMac and Washington Mutual, the S&L crisis showed that the FDIC by no means is ignoring smaller cases. In fact, the average recovery during the S&L crisis was only a couple of $1 million, and most of its targets were Ds and Os of banks with less than $1 billion in assets. The FDIC has said they're going to go for cases whenever they deem it cost effective to do so. So we can expect that they are likely to bring a large number of cases even when the expected recoveries are not necessarily promising to be much greater than the expected cost of litigation. We're running a little bit short on time, so I'm going to skip over what the FDIC does. I'm happy to talk to those of you on the phone after the conference who are associated with FDIC-insured institutions. And let's skip right to the D&O insurance issues. Demand letters are often being sent by the FDIC not just to directors and officers, but also to insurers to make sure that there's notice of claims before the policies expire. Historically, D&O insurance is a very significant source of recovery for the FDIC. In those cases where there's very little or no D&O coverage and the directors have few personal assets, you would assume that litigation is not as likely to pass the FDIC's cost-effectiveness test. And you might be inclined to think, well, maybe it wouldn't be so bad if I don't have coverage, then I'm less of a target. However, in several matters, there have been claims that have run aground because there's been an exclusion or it's been clear that D&O coverage has already been exhausted or is not available. And in some of those cases, the FDIC has not filed suit itself, but in some cases, they've simply referred the case to the Department of Justice for a criminal investigation. And obviously, at that point, insurance is critical for defense costs. Let's move on to talking about SEC enforcement and some of the recent developments there. This applies to any company, institution, or individual that is subject to SEC jurisdiction. Obviously, that includes public companies or anyone having anything to do with the sale or transfer of securities, which often can be broadly defined. This is another separate litigation threat from the FDIC and the Department of Justice and other government agencies. There are a number of recent developments that indicate that the SEC is likely to become busier than it has been in the last year to year and a half or so, when it's been somewhat distracted by a reorganization in the enforcement division. Of course, that's assuming that budget issues are resolved. If those issues are resolved, we can expect a couple of things. One is the Dodd-Frank Act has what is currently a pretty expansive whistleblower provision. It's already caused what both the SEC and many plaintiffs' lawyers are saying has been a large spike in the number of people who are going to the SEC and to plaintiffs' firms. It requires the SEC to award between 10 and 30% of all recoveries over $1 million to whistleblowers who satisfy certain requirements that are similar somewhat to the Federal False Claims Act. The SEC has also started to become much more aggressive in using the tools that it was given back 8 or 10 years ago as part of Sarbanes-Oxley and the regulations and related statutes and rules that came about in the wake of Enron. One of those, for example, is SOX 304. That allows the SEC to claw back bonuses, base compensation, and other compensation stock-based compensation from CEOs and CFOs who've signed certifications with a certain proximity in time to financial statements that have since been restated. So keep that in mind if your institution is looking at a restatement. Just in the past year or so, the SEC is starting to use that SOX 304 as basically a strict liability standard. What that means is that the SEC is now going after CEOs and CFOs under this provision who, it is undisputed, had nothing to do with the underlying factors that led to the restatement at their companies and are not in any way at fault. The first such case was filed in Arizona last year against Maynard Jenkins, who was the CEO of CSK Auto. And there's been a general sense among many in the defense bar that the SEC is reading this too broadly and that it's unfair to go after CEOs and CFOs who have no fault but yet could suffer severe personal financial consequences. The Jenkins case is not going to resolve that issue because it recently settled. Another thing that has been in the papers quite a bit, I won't talk about too much, is there's a much more of an intense focus on insider trading cases, particularly using wiretaps, as in the current Rajardhan case. Also, there are more tools available to the SEC in terms of aiding and abetting. They can go after aiders and abettors under the whole panoply of federal securities laws, not just Rule 10b and the 1934 Securities Exchange Act. They have a new cooperation initiative at the SEC put into place last year, which allows the SEC to provide written cooperation agreements to those who agree to cooperate, as well as deferred prosecution agreements. And they've also tried to streamline the process of getting witness immunity requests through to the Department of Justice. Another provision of Dodd-Frank that's gotten some attention recently has been the SEC's ability to go after individuals in administrative proceedings versus in federal court. The most high-profile example of that is the case filed just a few weeks ago by the SEC against Goldman Sachs director Rajat Gupta. His counsel recently sued over the forum choice because there are a number of downsides of an SEC administrative proceeding versus federal court. One of them is that the SEC is the one who's reviewing the judge's decision in the case. Plus, there's much more limited discovery for defendants versus the SEC, who still has its full suite of tools that it can use to investigate and work up a case. The next category we'll talk about is private plaintiffs. We're not going to spend a lot of time on this. The last few years, particularly post-Enron, there have been more and more cases in which companies are not giving a full defense of their directors and officers, particularly former directors and officers. In some of those cases, the company is actually taking over as plaintiff. That's something that was seen very rarely in the past, and that's being seen more and more these days. It's still very common that derivative cases will end with a settlement payment, and the plaintiff's counsel will have attorney's fees paid, and there will be various changes at the corporation. Those are still very common, but there are more and more cases where the company is essentially turning on particularly former officers and former directors. One wrinkle in terms of derivative actions in the FDIC context, for those of you on the phone who are affiliated with financial institutions, it remains to be seen what the role of derivative actions will be when the FDIC is already on the scene. There was a recent decision in which the FDIC was able to dismiss a derivative case, holding that the FDIC is the one who has the right to bring those types of claims. Recently, plaintiffs' lawyers have wised up to that, and they're starting to plead around that by avoiding breach of fiduciary duty claims. In a recent case, they alleged negligent failure to disclose rather than breach of fiduciary duty. In another case, they alleged negligent misrepresentation, and they're trying to plead around that so that they still have an opportunity to bring derivative claims. Securities class actions, similar to derivative actions. The last few years, there's more targeting of individual officers and directors than before. It's no longer an afterthought that individual directors and officers automatically will have the same counsel as the company and automatically will be taken care of in any settlement or any resolution. Again, there are more cases where the company has turned out to blame the directors and officers or not covered them. And a lot of that is driven by companies' desire to cooperate with government enforcement authorities, which often come along before the securities class action gets resolved. And a lot of that is driving the blaming of former directors and officers. It's becoming more common. Generally, there have been fewer settlements recently. The total settlement values have started to go down. One reason for that is pleading standards have been tightened up in the securities class action space, so it's getting harder to plead those claims. I think it's also, plaintiffs have had some difficulty differentiating their losses from market conditions over the last couple of years. That's another factor. False Claims Act is heading in the opposite direction. There's quite a bit of recent legislation that that mean that more False Claims Act cases will survive motions to dismiss. It used to be very rare for False Claims Act cases to be brought against directors and officers rather than just companies, but they do happen. Often they're not worthwhile for individual whistleblowers to bring, but Department of Justice has pursued directors and officers in a number of actions recently. Just to conclude, we're going to talk about, obviously, directors and officers insurance in a minute, but there are a couple of legal developments that I think are worth mentioning. One development that I've seen recently is you can be aware of what the bylaws provide and what your advancement rights may be, but you have to make sure that if anything happens, if there's any litigation or investigations, and the company puts an undertaking in front of you that says they will pay your counsel's fees during the investigation of the litigation. One thing I've seen recently is that companies are starting to put in there, in some cases, that they have the right to stop advancement of fees at any time in their sole discretion. They're basically trying to take away some of the rights that directors and officers have through bylaws or their employment agreements or indemnification agreements. So it's critical to talk to your own counsel if you find yourself in that situation. Another legal development that I think is significant, particularly down in my area of the country, in the 11th Circuit, that's Georgia, Alabama, and Florida, is that directors and officers' rights to advancement of attorneys' fees and costs took a blow in the last year or so as a result of a decision here involving Health South. The two major sources of protection for directors and officers against having to pay attorneys out of their own pockets are advancement and directors and officers insurance. However, what occurred in the Health South case is that the 11th Circuit held for the first time that unless a defendant can prove that he or she was merely an outside director who was an innocent bystander to the events in question, then the company is able to stop advancement. And as you can imagine, it may be difficult for somebody to prove that they're an innocent bystander when they're not being advanced fees for competent counsel to go out and prove that they are innocent. In that case, the court may have been influenced by the fact that they're dealing with claims against Richard Scrushy, and they thought it was unreasonable for him to continue to receive advancement. But in any event, it's the law in this part of the country, and it's something to keep an eye on. With that, let's transition into a discussion of the D&O insurance issues led by Ethan Lenz. Ethan is the person I call whenever I have any D&O insurance issues that arise for our clients. It's often my first phone call.
Thanks, Mike. We're going to just switch the discussion up a little bit now and end it with Ryan and I giving you a little bit of an overview of D&O coverage and how it impacts some of these issues that you might face as directors and officers of companies. And I'm going to take kind of a high-level overview approach just to make sure we're all on the same page. I think a lot of times there's a lot of confusion out there in terms of how the D&O coverage just works from a basic standpoint and some of these different terms that get thrown around, such as Side A coverage and things of that nature. Then I'm going to turn it over to Ryan, and Ryan's going to take a little bit deeper dive into some of the specific coverage issues and some of the more prevalent myths that are out there about D&O insurance. And so with that, if I can move my slides forward instead of backwards, actually. The typical D&O policy has at least two, and sometimes three different coverage agreements in it. And stepping back just a second, one thing to remember with D&O insurance, it's not like some of your more what I'll call typical coverages you might find throughout the company. It's not like a commercial general liability insurance policy where many of the provisions are standardized no matter which insurance company you might buy from. The provisions are largely the same. D&O insurance is a completely different animal. Every D&O insurer writes the policy on its own form, and those forms contain different wording from one company to another, and little differences in the wording can have extreme impacts on the scope and the breadth of the coverage. So you have to be very careful when looking at a D&O policy in order to understand how good the coverage really is. But in terms of the big picture overview, usually you'll get at least 2 types of insuring agreements or coverages in a D&O policy, a lot of times 3. And the sort of insurance industry lingo for those coverages is Side A coverage, Side B or reimbursement coverage, and then Side C or entity coverage. With that entity coverage, it's separate coverage for the company itself. And if you're with a privately held company, almost always your policy is going to contain entity coverage. Publicly traded companies, a little more variable, but still the majority of public companies, I would venture to say, usually include the entity coverage within at least their base program of D&O insurance. And talk a little more specifics on each of these types of coverage, what they are and how they impact the claims process potentially. The Side A coverage, this is the one you hear a lot of banter, gets a lot of press out there, and it's coverage for individual and directors and officers when they don't get indemnification for a claim that's made against them for something they did as a director and officer of the company. Now, Mike had mentioned a few minutes ago bylaws, indemnification agreements, other agreements that might be out there from the company that essentially say, well, if you are, as a director or officer, are sued for something you allegedly did while you were a director or officer, we, the company, are going to indemnify you for that. That holds up most of the time, but there's at least a couple of situations where indemnification might not be available, and that's where this Side A coverage steps in and serves as a backstop to you as a director or officer having to dig into your own pocket to defend that claim and ultimately pay any settlement or judgment there might be as a result of it. The 2 most common situations are when there's a statutory prohibition against indemnification, or when the company's insolvent. It's broke, it's in bankruptcy, it can't live up to its indemnification obligations to you as an officer or director, but despite that, there's still claims out there against you as an officer or director. Company can't indemnify in the insolvency situation. Your Side A coverage under your D&O policy should kick in and provide coverage for your defense costs and any settlements or judgments, of course, up to the limit of the policy itself. Back to the statutory prohibition situation, what you're dealing with there is the primary example of where Side A coverage might kick in is in the derivative claim context. And what happens there is there are a number of states that have statutes that essentially say in the derivative claim context, at least any settlement or judgment that arises from a derivative claim that's made against you as a director or officer cannot be indemnified by the company. Again, Side A steps in that situation. The rationale behind those statutes, too, is essentially that you're dealing with a situation where the derivative claim is, in most cases, based on some type of an allegation that you as a director or officer have somehow contributed to the waste of corporate assets. If the company indemnifies you for the costs associated with a settlement or judgment from that claim, essentially the company is repaying itself, at least the theory goes, for assets of the company that were wasted. It becomes a interminable circle in a certain sense, and that's why you have the statutes that prohibit indemnification in those situations sometimes. Other thing to remember with Side A coverage is there's typically no retention. Again, Side A coverage is sitting there. It's your last, it's sort of your last defense as a director or officer against having to dig into your own pocket. So there's no deductible or retention on it, and it's meant to kick in at $0 when the company can't indemnify. The Side B coverage, also often referred to as reimbursement coverage. This is where most of the action is under the D&O policy, or at least traditionally has been on the D&O policies. And the way this part of the coverage works is it provides reimbursement to the company itself after it lives up to its indemnification obligations. Suit is filed, you as a director or officer are named as a defendant in that suit. Company lives up to its indemnification obligations, pays for your defense, ultimately pays for any settlement or judgment against you, it turns around to the D&O insurer and says, I've lived up to my indemnification obligations, reimburse me. Again, most of the coverage is under Side B. Most claims are indemnifiable as long as the company isn't insolvent. It's going to indemnify you as a director or officer. It's then going to collect from the D&O insurer. Typically, the big difference between the Side B, the other big difference between the Side B and the Side A coverage is that there will be a retention or a deductible on the Side B coverage. If you're a director or officer of a publicly traded company, usually that retention is pretty sizable. Sometimes in the mid to upper six-figure to seven-figure ranges, in some cases even higher, depending on the balance sheet of the company and how much of a retention it can ultimately afford to take. The last type of coverage that you find, again, in most D&O policies is the so-called Side C or the entity coverage. And again, that's coverage when there is a claim made against the company itself or the company itself is a defendant in a claim. Typical example there is your securities class action lawsuit if you're a publicly traded company. What usually happens is individual directors and officers are named as defendants in that class action. The company itself is also named as a defendant in the class action. That's when your Side C coverage kicks in and provides coverage. Not only you have the Side B coverage, presumably for the directors and officers as individuals, you have the Side C coverage covering the liability of the entity itself. When you're dealing with a privately held company, your Side C coverage will apply to any claim against the company as long as it's otherwise covered under the policy. With a publicly traded company, your Side C coverage almost always applies only to securities claims. The thing to remember with Side C coverage, if you're a director or officer, is essentially you are sharing the limits of your policy with the company itself. Part of the limits of the policy potentially are going to be used to get rid of liability of the company itself when it's sued jointly with you and as part of one lawsuit. And so you have a sharing of the limits. That's the reason, and Ryan, I think, will go into this a little more detail here in a bit, but that's the reason many companies, particularly publicly traded companies, will often buy some separate Side A only coverage for directors and officers to give them an additional layer of protection as individuals in case the limits of insurance are gone and the company is not able to indemnify. A few other things to remember with respect to D&O coverage. First one is it's claims-made coverage. Almost every D&O policy is written on a claims-made basis as opposed to an occurrence basis. The difference being the D&O coverage only covers claims made while the policy is still in force. If you were dealing with an occurrence policy, what you have in that instance is the policy covers any occurrence that happens during the policy period, no matter when the claim is made. So your occurrence coverage spreads the coverage out potentially over a much longer period of time, whereas your claims-made coverage has it covering only a very set period of time. If your D&O policy is not in place when a claim is actually made against you as a director or officer, there is no insurance available for you. It makes it very important, particularly in the M&A context when a company is being acquired, or in the insolvency context when the company is potentially going away. It makes it very important that you're looking at so-called tail insurance, which will extend the claims reporting period under the policy. Because if the company simply goes away, it's acquired, or it is insolvent and it's effectively dissolved as a part of the bankruptcy proceeding, that company goes away, there's no D&O insurance left, and a claim is later brought against you as a director or officer, you're on your own at that point if the D&O coverage has not been extended by way of a tail. Another thing to remember with D&O insurance is that typically the insureds are going to retain the right to defend and settle claims. It's always subject to insurer consent, but unlike your, for example, typical general liability coverage, with D&O insurance, you as a director or officer, an individual insured, and your company are going to be able to control the defense in most instances, again, subject to insurer consent. In terms of the overall scope of coverage of the typical D&O policy, it's usually very broad. The trigger for coverage under D&O policy is that there has to be an allegation of a wrongful act. And that's usually very broadly defined. Something like any actual or alleged act, error, omission, misstatement, misleading statement, breach of duty by an insured in their capacity as such. If you're sued for anything you allegedly did as a director or officer, at least in the first instance, under the wrongful act definition of the policy, it gets pulled into the coverage. The trick with D&O insurance is that there are a lot of exclusions. And this is where you really have to dig into the details of the policy to determine how good that policy is. Because the exclusions are written all over the board in terms of the breadth of those exclusions and where they're found. D&O insurers are tricky. They put a section in almost every D&O policy that's specifically entitled exclusion, and it contains express exclusions, things like knowing fraud, illegal personal profiteering, and a number of things in that area. But in addition to the express exclusions, there are also exclusions buried in other places throughout the policy. They can be found in the definitions. Typical one there is your definition. D&O policy will usually have a definition of a term called loss, which is we cover, and the policy will say something to the effect of we cover, quote, loss under this policy. Well, loss will often be defined as loss includes all damages, defense costs, everything of that nature. However, loss doesn't include, and there will be a laundry list of things loss doesn't include. Might be something like punitive damages, exemplary damages, multiplied damages. Any number of other things might be buried in that definition of loss that aren't covered under the policy. So it's another way of working an exclusion into the policy that isn't necessarily found in your definition or in your exclusions section of the policy. Other big place to look for non-exclusion exclusions is in the conditions section of the policy. Typical example there is that there will be a provision in the policy that will deal with the situation where there are allegedly misrepresentations in the application for the policy. And there will be a condition of the policy that will say if there are misrepresentations in the application, anyone who knew of the misrepresentation loses their coverage under this policy. Again, it's another exclusion. What you can run into with that exclusion is that you might have that condition also saying not only will the person who knew about the exclusion lose their coverage, but if it's the CEO or the CFO, the company itself will lose its coverage. And there are some insurers out there who still have a condition that says if there's any misrepresentation in the application, no matter who knew about it, all of the insureds potentially lose their coverage under the policy. So you have to be very careful in looking at all the provisions of the D&O policy in order to understand the complete scope and the number of exclusions under the policy. So with that, I'm going to turn it over to Ryan to talk about some of the other myths that are out there and take a little deeper dive on some of these coverage issues.
Absolutely. Thank you, Ethan. I figured we'd have a little bit of fun with regard to D&O, because D&O can be very nauseating and cause a lot of insurance fatigue. So I wanted to go through some of the myths that I hear on a regularly routine basis with both some of my clients as well as prospects that I meet with that might have been told some things throughout their relationships over the years. So from a D&O perspective, as Ethan had mentioned, these policies are not the same. These policies are absolutely going to have differences from the font all the way down to the intent. And that's where myth number one, I've heard many times that all D&O policies are created equal. And that's not the case. Every single carrier out there, with the exception of two that I can think of that stole each other's wording and both won't admit it, are different. They all have different intent. And as Ethan had mentioned previously, the exclusions are different, the conditions are different, the wording is different, the ability to add endorsements are different, and each carrier has idiosyncrasies amongst themselves that makes them different as well. So one of the things that we've built for a tool for our clients is we wanted to build essentially a heat map for our clients to show them exactly how these policies compare. So we have 100 different items that we look at for a privately held company and 135 different items that we look at for a publicly traded company to assess the differences in these forms. That's how night and day they can be. Also, I've also heard many times in the past that policies are etched in stone. You get what you get. You have a carrier. They're going to give you your off-the-shelf endorsements, and that's not the case. A lot of times we are able to fix and amend the form, and we often work with outside counsel, such as Ethan and Foley and Lardner, on getting our clients the strongest possible policy. The underwriters are never going to give you what you do not ask for, so you need to ask for it, work with outside counsel. It's very wise. It's insurance within insurance, and get the policies to have as broad of cover as possible. Sometimes you can have as many as 60 endorsements to a policy, 60 improvements to a policy. Number three, down below, the most well-known carriers offer the best coverage forms. This is absolutely not true. The carriers that everybody knows of, the name brand carriers that have been around, referred to as legacy carriers, the name brand carriers often don't have the best coverage forms. They don't need the best coverage forms because they have the name brand recognition of their clients, and that name brand recognition allows them to write the policy, and that sometimes they have some pretty egregious coverage issues in the form. There's one A+ 15 carrier that everybody's heard of. I don't want to use the name. I did a review of the policy. It was a tough, stressed bank, and they had removed the Side A coverage. And a stressful bank that is near zombie status does not want to lose their Side A status. That's the last bastion of hope between the individuals and their checkbooks coming out to pay the claim. And that is absolutely not something that you want to be dealing with. Number four, why we buy the coverage? D&O carriers don't pay the claims. Actually, the numbers say otherwise. These are the overall combined ratios of the insurance carriers, and for those that don't know exactly what a combined ratio is, a combined ratio essentially shows for every $1 of premium the carrier brings in, how many dollars or dollars and cents do they pay out. And you can tell from 2010, for every dollar an insurance carrier brings in, they're paying $1.03. And as you can tell, we've had a very, very soft, client-favorable market for many years, and that will change eventually when the carriers get to a pressure point where they cannot any longer reduce the premiums, because right now they're paying 3.5 cents more than they're bringing in, and that just cannot be sustained. Fifth myth is continuity doesn't matter. I have seen many folks that just buy their D&O policy as a commodity, and that's perfectly fine to have that philosophy if you're buying your homeowners or your auto insurance where the policies are ISO-based. What we have with D&O is a very esoteric form, and continuity does matter because there's a couple of reasons. One, you want to maintain that relationship with the carrier. In the event of a claim, these claims often come in the form of gray area claims. They're not black. They're not white. And we want to make sure that you have a nice relationship with that carrier. However, if you have a bad form, don't feel compelled to maintain the relationship with that carrier. It really takes a lot of effort and a lot of diligence to make sure that you have a strong form. And if you don't have that strong form, do not hesitate to cut ties with that carrier and put the coverage with a carrier that will offer that strong form. Number six is one, if anybody's on this call and they happen to be a director or an officer of a company, this is real. D's and O's don't ever pay out of pocket. It doesn't happen often. And, I hope it never happens to one of my clients. So far it hasn't. But it is rare. But if you want to Google an account or a situation where it did occur, Just for Feet, small publicly traded company in the Southeast, they had a restatement of their revenue and ended up having to have the outside directors pay checks totaling over $41 million. I don't know the exact details, but I think the restatement might have been about $7 or $8 million. So it was not a big restatement, but nonetheless, the way it all settled out, the individual outside directors had to contribute $41+ million out of their personal checking accounts. And that's not a good day for anybody. Next one, I've heard many times on the private company sector, if you're not a publicly traded company, you're a privately held company or a nonprofit company, that there are not a lot of D&O claims, and that's just not true. There are a ton of D&O claims, and the way privately held company policies are construed, as Ethan had mentioned, they have entity coverage, and they're very, very broad and all-encompassing when crafted properly. Chubb did a survey showing that about 1 out of 4 privately held companies had a D&O claim within a 5-year period. That's a big number for me, and if you think about it, that's a big number for a lot of folks that say they never have had claims. In the public domain, I've heard many folks say that public companies are becoming more better risks. They're becoming less problematic, and they don't need to buy the limits needed because the litigation is down. And class action, typically you'll see 200 to 250 class actions in a year. Last year it was quote unquote down to 176. We cannot be fooled by the fact that class action litigation is down to 176. If you look at all securities lawsuits, the traditional way to file a claim is through a class action litigation. But as Mike had mentioned, there are other ways to file claims. There's derivative lawsuits, there's strike suits, there's merger and acquisition suits. Anytime a company gets purchased in the public domain, there's going to be a lawsuit alleging inadequate compensation or inadequate consideration. And with that, that's a D&O lawsuit, and that's going to likely have a payout. Last year, there was a record number of securities lawsuits, over 1,100 of them. And if you think about it, there's only, by the estimates I've seen, about 13,500 publicly traded companies out there. That's about 1 out of 10 have seen securities lawsuits in the last year, which is a trend that is somewhat alarming because 1,170 underwriters cannot make a profit, so they'll have to ultimately start to increase pricing. Going to the last couple, I only wanted to have 10. I could probably come up with 100. One of the issues that Mike had also mentioned with the FDIC in particular is the fact that these claims have extended delays or lag times before they get filed, especially in the public domain. Typically, it used to be back when Bill Larack was a plaintiff attorney, it would be a race to the courthouse. As soon as a stock drop would occur, the plaintiff firms would line up, run to the courthouse, and try to be the first in. That way they could be the lead plaintiff and hopefully reap the bounties of being such lead plaintiff. Now we're seeing a very, very large lag all the way up to sometimes the statute of limitations, up to 2 years. The average lag time for a claim to get filed now is over 250 days, when before, if you think back probably to the mid-90s, it might have been under 10 days. Now we're seeing a doubling in the last 3 years, and many folks think that they've weathered the storm. There has not been a claim. It's been a long time. That's not true. You got to get up until that 2-year statute of limitations, hope that you don't get a tolling agreement, as Mike had mentioned, and then if you get that, then maybe you're safe. One really interesting note, as Mike had mentioned, a tolling agreement could arrive right before the statute of limitations ends. Oftentimes, you'll see the general counsel or the outside counsel will look at the tolling agreement. They will sign the tolling agreement. They will give it back to whichever party has given it to them, and they'll put it in their drawer and forget about it. Some of my peers in the brokerage community have built privately held and publicly traded forms to include a tolling agreement as the definition of claim. If you sign this and put it in your drawer and don't file it with your carrier, any subsequent D&O lawsuit will not be covered due to late notice. I met with one of my now clients, and they had signed 44 tolling agreements over the past year. Had any of those turned into a claim and they had not reported them as a circumstance, they could have lost their D&O coverage for that follow-on claim that stemmed from the tolling agreement. That would be a huge shame, but the policies are created now so broad sometimes that the law of unfortunate or unthought outcomes leads our clients to lose coverage. Not our clients, but other clients. Last issue, this is not a commodity policy. D&O insurance, most people think it's the same. I'll say it's the cheapest option. That's not the case. The cheapest option usually is fraught with peril. There are many carriers that are known as the cheapest carriers out there, but they also have the most exclusions. They have very inadequate policies. You need to look at the value of an insurance policy rather than the premium of an insurance policy. The value consists of the breadth and depth of the coverage, the premium charged, but also the strength and security of the carrier offering the quote, because these claims might take 2 or 3 or 4 years to settle, and if you don't have a carrier there in 2 or 3 or 4 years, you've got to get in line with the rest of the creditors to hope that your claim could get paid. So you need to look at the value beyond just the premium. And also you want to take a look at the claims handling. Every carrier handles claims differently. Some are very normal, some are very draconian. And draconian is not where you want to be when you have your claim handling with your carrier. So there's quite a few different issues that you want to take a look at, but I just want to go through 10 myths that we hear on a somewhat regular basis, and maybe some of you might have had those myths before, maybe not, but some of the other myths, and Ethan had alluded to before, is the no need for Side A coverage. Side A DIC, or Side A coverage in the policy, that's the last bastion between you and your checkbook coming out, and a lot of my clients, both public and private, are looking at buying a separate dedicated Side A DIC policy because there are only 2 exclusions on a very well-constructed Side A DIC policy, and in the event your company cannot indemnify you or will not indemnify you, you've got dedicated limits available solely to the individuals, which is a nice piece of sleep insurance to offer to the individuals. With that, I conclude, and I will turn it over to Ellie and or Ethan for a panel discussion.
All right, thank you all very much today for speaking. Ethan, do you want to go ahead and lead the panel discussion, or do you want to open it up for questions and answers?
Sure. We'll go ahead and start with a little panel discussion. As we're doing this, if anyone on the line has questions, please feel free to submit them, and we will certainly try to answer them either yet today or one of us will get back to you with answers as well. And Aaron, I've got a question for you that I've been dying to ask since I saw the slide, and I hope I don't show that I'm geographically challenged by this. It has to do with the United States map you had for the potential problem banks. And the thing I was surprised by was, if I've got my states right, Nevada and Arizona are both white. Is it because the problem banks have already been identified and are either gone or otherwise taken care of in those states, or why is that?
No, you got it. The larger problem banks, those with greater than $1 billion in assets, have already been resolved. And, if you did this map or this analysis with a asset size that was below $1 billion or potentially even below $500 million, you'd find a very different picture. There are a lot of little banks there that will likely be resolved or maybe in need of some other type of, if it's not FDIC resolution, another transaction. But related to size only, those states which are actually economic hotspots or problems do not have larger banks that are headquartered there. That are in trouble.
All right, and then the other thing you had mentioned back in the M&A context was you're seeing more maybe of a, or at least predicting more of a return to normal this year from an overall M&A activity context in the banking industry. Any thoughts, any flavor you can provide us with just more of a macro view for the overall market? I mean, it seems like every day I'll read one story saying M&A activity is picking up. The next day I'll read a story saying, we don't know, it looks like the next downturn's coming. And any overall thoughts from your perspective on that?
Sure. I think a couple of things to call the group's attention to. There are certainly some notable deals that are getting done. Of course, you saw AT&T's very large transaction with T-Mobile. What you're seeing, if you track M&A, is you're seeing a return of strategic buyers and strategic transactions. These are companies that are operating in the sector that they're likely doing an acquisition, and there's either a bolt-on business line or some business synergy. You're seeing a few notable leverage transactions or financial transactions, but PE shops, while they have a whole lot of cash to work with, are not finding the same types of leverage relationships or lending relationships that they've been able to deploy in the past to really leverage their return to what had then been a very attractive metric. So as you see a return of strategic buyers, I think you're going to see strategic buyers tend to be a little more disciplined. Strategic buyers tend to deploy less leverage in these transactions. There's a rationale for the business combination. They're not looking to just go in and maybe do what a PE shop is doing and turn that business around and sell it. That generally results in pricing, or from a valuation point of view, that's a little more rational over time. And I think you'll likely see that trend continue just from a macro perspective. And a lot of that has to do with access to leverage, access to the securitization market. And I think that as the overall market begins to improve, both from an economic point of view and from a lending point of view, you'll see a return to some maybe more robust M&A activity. But right now it's really the strategics that are going in and deploying their cash.
All right, that makes sense. Thanks a lot. Turning to Mike and Ryan, this may be a question for either or both of you, really, and it has to do with the both of you had talked a little bit about lag time, and that, of course, has the interplay with D&O insurance given its claims-made nature. Is there a typical lag time we're seeing on these FDIC suits in terms of number of months from bank failure or the time the FDIC steps in and takes it over to the time suit is actually filed, or anything we can learn from the S&L crisis even about what that lag time might be?
Yeah, this is Mike. I mean, some of it is hard to predict because it is often not public which cases are subject to tolling agreements and which are not. You can make some guesses. For example, IndyMac was filed 1 year and 355 days after the failure. So a lot of these cases they're looking at 2 years as sort of a minimum statute of limitations. But again, if a lot of these cases are subject to tolling agreements, and so it makes it difficult to say that, you know, a bank failed on X date and therefore we're going to see a lawsuit on Y date. But at least as far as I've seen, there are many more suits being contemplated, and certainly the ones being authorized. We know those because the FDIC posts the numbers to its website that have actually been filed. It's often a much longer time frame than you would see with private plaintiffs. A lot of the financial crisis cases not only were already filed by private plaintiffs, but they're already resolved, either settled or a lot of them have been dismissed. So it tends to be a much longer time frame than when private plaintiffs are filing, often a factor of, you know, at least 2 years, if not 3 or 4 years, depending on the tolling agreement and the circumstances.
Yeah, I would concur with that. And one real nugget of wisdom I've gone through with many people is to be in contact with your broker on a regular basis. Once you start getting noise regarding a claim, whether it be a tolling agreement, whether it be just some documents, you know, investigations, whatever it might be from a noise of a claim perspective, get in contact with your broker and scour through the policy, and then also try to figure out if you need to get your outside counsel involved immediately as well, so you procure your rights to the policy. Nothing good happens hoping that things will go away. Many folks, and it happens with EEOC claims as well, where they don't want to file the claim, they want things to go away, they think things will work themselves out. That's not the case. Protect your rights under the policy, get the claim filed, whether it be a circumstance or a claim, get it under the policy as soon as it triggers the policy.
Right. I would agree with that, Ryan, and that actually plays into the next question I was going to go to with you as well. One of the things I've seen in some situations, in the failed bank situation particularly, is that, you know, the FDIC steps in and suddenly the directors and officers have somewhat scattered, and they start individually getting notices from the FDIC about potential claims. They start getting other communications, subpoenas, and everything else. Any guidance there in terms of how they, you know, the directors and officers have typically been used to the situation where the company receives all this stuff, they put the D&O carrier on notice. What's the best course of action for the individual at that point?
Absolutely, it differs for every situation. Oftentimes there will be one counsel chosen by the entity for all of the individuals to contact in the event of any sort of documentation. Today's world, that might not be the best way to go because you could see a conflict. You could see a conflict between the entity and the individuals. So they really need to have almost an attorney on retainer, have a relationship with their broker, have a relationship with somebody to help walk them through the details of what is going on. Because a claim being filed could be missed very easily by a layman, and then they lose their coverage by not turning it in a timely manner. But every situation is really different because I've seen some directors and officers almost try to evade being contacted, and that's not going to work. But it's helpful if you have a single contact point before the company dissolves.
All right, and with that, Ellie, I think we are probably bumping up against our time limit here, so I will probably turn this back over to you.
All right, thank you all for joining us. Let's see real quickly if we have any questions on the line, because I think it's important to get to those since nobody typed in any online. Operator, could you go ahead and see if we have any, please?
Okay, thank you, ladies and gentlemen. If you have a question at this time, please press star then 1 on your touch-tone telephone. If your question has been answered and you wish to remove yourself from the queue, please press the pound key. Once again, ladies and gentlemen, if you have a question at this time, please press star then 1. And our first question comes from Sanford Victor from Argo Insurance. You may ask your question.
My question is going back to some of the litigation risks. It was very interesting to hear about companies taking over effectively derivative suits and becoming involved in class action suits against former officers, maybe motivated in part by pleasing governmental entities. But there are implications for the company getting involved against a claim against an individual under most companies, under most D&O policies, insured versus insured exclusions. And I didn't know whether anyone on the panel had any comment about how an entity taking over a derivative suit could affect the availability of D&O coverage for any recovery because of the IVI exclusion.
Well, this is Mike Matthews. I'll let Ryan or Ethan or someone else answer the exclusion question, but the answer is, in a lot of cases when the company has taken over a derivative case, there's not even any question that the individual is not going to be able to take advantage of insurance to pay a claim under that situation. But there are situations where the company is considering taking over a claim in a derivative case, and yet they have a class action pending against them. And the securities class actions, the company is always on the defense side, and it does cause some risk for companies and causes some hesitation because of that exact exclusion. But I'll let the insurance guys talk about the exclusion itself.
Right, and this is Ethan. The IVI, depending on how it's written in the primary insurance program, with a derivative suit, it may or may not knock out the coverage, but the class action situation, if the company is driving that suit, it more than likely is going to. And that's where you can get a lot of value out of these Side A and DIC policies potentially, because in a number of those, and you have to read these very closely, number of the Side A and DIC policies, you will see that the insured versus insured exclusions have actually been removed, and they can potentially drop down and protect the individual directors and officers from those types of suits. Ryan, other thoughts on that?
No, that's exactly correct. I've actually seen where one of my clients sued a former director for many allegations, and ironically enough, the Side A DIC policy did pick it up. So it was almost as if they were suing themselves because it's the policy that they had put in place for the benefit of the directors and officers. But it really comes down to the individual policy, how it's constructed, and how the claim is filed as well.
Thanks.
Once again, ladies and gentlemen, if you have a question at this time, please press star then 1 on your touch-tone telephone. And I am showing no further questions in queue. You may continue.
All right, thank you very much. On this next screen, you'll be able to see the contact information for our speakers. This PowerPoint will be posted to our website within 24 to 48 hours, so you'll be able to get their information from that as well. Here's the link here to where we will post it, but you will get a thank you for attending email that will have the link to the PowerPoint as well as this recording and any other materials as well. If you can just take a few minutes before you leave our web conference today to fill out the survey that is now on top of your screen, we would greatly appreciate it. Thank you again for joining us, and we hope to see you at a future event. Operator, it is now up to you.
Ladies and gentlemen, thank you for your participation in today's conference. This does end your conference call for today. You may now disconnect and have a great day. Speakers, please remain on your line.